Hi everyone, welcome to Know Your Numbers webinar. I'm Nikolai Naylor of Naylor Accountancy. So welcome, nice to have you here. Thanks for giving up your time to go through this. So the point of this is just to try and sort of give an idea of the numbers, hopefully give you some insights, and it's just something you can sort of take away with you. We should be probably 45 minutes through it, and with 15 minutes for questions at the end, but just go to the next. Oh, this is just a welcome. But if you just sort of put Q&As in, then we can sort of deal with them at the end. So just very briefly, with Naylor Accountancy, we basically have core values. So we have it's integrity, care, have fun, accountability, respect, growth, and excellence. So it's like an excellent service, help each other grow and the business grow, and integrity obviously with everything we do. And we try and have fun just because with you guys and the clients, and also with our team, just because it makes things a bit more pleasurable when you're doing work. But this is just a quick overview. So if you have been to the webinars, I do go through this right at the start, just so those that aren't aware of it are aware of them. So the other thing is our core purpose. So we have a core purpose. We always call ourselves your partner in finance, because we try and sort of be your partner in finance to help you with what you need. So that's to help you grow potentially, and also we use technology to make your life easier and sort of help get what you want from your business, which either is, financially, so more money, or time, so you can spend more time with your family or things that you want to focus on, or mind, just peace of mind, because somebody's dealing with HMRC when you need that. So this is just a breakdown of it. I won't go into that in too much detail of the integrity. So we do have this webinar schedule. So with the webinar schedule, we've already done Build a Better Business in April, and 3 essential tools for business. So we've already done those. So if you've been to those, I hope you did enjoy them. We will be doing the rest here as well. So at the moment, we're going to be doing Know Your Numbers. So we spoke about core values right at the start, which is one of the ones we're doing in September. In summer, what I'm going to do is actually send out, because I'm going to be on holiday. I'll probably end up sending a recording if I am on holiday, just so that if anyone wants it, and signs up, I can send that to them. But these are all to try and help you. And what I do like, if you don't mind, is if there's anything that you think that's not on here that will be useful for you, let me know, because we can look at potentially building a webinar program around these. Just so you know, we used to do seminars, not webinars. Obviously, with COVID, we've had to go into webinars. That's how we do webinars. We may end up doing some more seminars once things settle down a bit, which hopefully they will. So obviously, this is a Zoom. So just thank you for joining the Zoom, like I said. And if you've got Q&As, just do the Q&A, and then we can come to the questions. If you've got them as I'm going through it, pop them in. I'll answer them at the end probably. If I can answer it during it, do let me know. But then we can always answer it at the end. And if you do leave the meeting, you can always rejoin on the link. So don't feel that that's a problem at all. So that's just a bit of housekeeping. So just a thought before the session is, the budget is not just a collection of numbers, but an expression of our values and aspirations. That's Jack Lew. So it's just a little, hopefully you've sort of updated your budget forecast and reflected in the challenges for COVID, because COVID has actually been a big challenging for everybody, a massive challenge for businesses. Some businesses have thrived on it, other ones have had to pivot, and we've seen some businesses, actually our partners, actually doing really well through the pivoting, and they may not go back to what they did before, or they may be doing both, so they've actually suddenly got another arm. And we've seen that with some sort of niche shops that we've got. So they've now got some online presence, which they didn't have before, and we've seen other people totally switch in almost what they do. So it's been a very interesting way of doing it. The aim of this this webinar, is literally just to sort of try and demystify some of the things on reporting, and just sort of, because sometimes we speak Accountanese, which is not always understandable to everyone. So it's trying just sort of explain things, what's important to look at in key reports that you potentially have. If you've got QuickBooks or Xero, you will be able to have lots of these reports just at your fingertips, as long as everything is up to date on the bookkeeping side, which is critical. So the agenda. So what we're going to just focus on first is why you need your numbers. And then we're going to do an overview of the reports. There's about 6 reports that I'm just going to go into in detail to some degree. And then the difference between profit and cash. I'm sure most of you know that, but it's just something that we need to sort of just make sure we cover, because it's not the same. The key drivers for business value. So there's loads of key values, but these are just focusing on a few, just to see what you can do to potentially drive a bit extra value in your business if you need it, or extra cash. And then there's the ways of protecting your assets. So we're just going to cover a few there that are around. And then there's potentially some next steps you may wish to take. And always, I mean, what I'd recommend is, if you think of anything you might want to be doing through this, do just take notes, because then, try and think of 3 things that you might want to look at, and then questions right at the end. So we're going to start just with why you need numbers. So they tell a story. So that's the first thing, and there are 6 reasons to me, and that's to tell a story of your business, allowing you to sort of interpret the results of your business activity. Now, as an accountant, I obviously found this, and we all do in the accounting practice, fairly straightforward, because that's what we deal with all the time. But as business owners, it's not quite so straightforward all the time. So and it just helps identify symptoms, versus the root causes. So for example, if you have a decline in gross profits, it's potentially a symptom of something that's a root cause of, in effect, it could be like pricing, people rework, so you have to do rework of work that's already been done, so you're actually spending too much time on work. Poor purchasing and wastage, those are just some examples of what it could be. And then knowing your numbers, it just allow you to spot an early warning sign of potential issue. And I've had an example of this where we did actually a cash flow forecast, and I've sort of probably mentioned this in other webinars for other people in other webinars. And we did it for a partner, and they basically had to, unfortunately, make a lot of people redundant, because they were going to be running out of cash very quickly, and they had to refocus and cut costs very quickly, and then try and sort of generate more income at the same time. But otherwise, we could see sort of in 6 months, 9 months time, they were going to start running out of cash. So by doing that, they've actually turned everything around, which has been really good to see. But there's other things that can happen. So monitoring how long it takes customers to sort of pay, so it just allows you to get paid quicker as well. So areas of strength and weaknesses, that's also highlighted in numbers. So for example, on the balance sheet, just say where the business value is going up or down. There's lots of things on your balance sheet which can change that. So there's various items, but it does tell a story. Then understanding your numbers also means you have reliable financial information just to sort of base your decisions on. And one we look at is real time. So the way we are is that we try and do things real time, in that the bookkeeping, so we'd like you to do your bookkeeping, we'll do your bookkeeping for you. So it's real time in Xero, QuickBooks now. So the idea there is that you can see what you're doing. If you have questions with us, we can see what you're doing and have a conversation with you real time, rather than waiting for the year-end accounts, which is just historical, and it's almost too late to do anything then. So, and then finally, just knowledge is power. You hear that all the time, but the more you know just about your business, the better the business will be, and the better your decisions will be to run that business. And that's key. So that's why you'd need them. So just the overview of the report. So these are just the 6 reports that we're going to go through. I've sort of created a bit of an example called Foods Company. Not because I'm hungry right now, but that's what we've sort of created. And it's just going through the trading account, profit and loss, just the balance sheet, statement of change in equity, just a depreciation schedule, so like the asset register, and the director's current account. So those are sort of 6 of the ones that we're going to just focus on key. And you actually get these in your year-end accounts, but they're also within a lot of the cloud accounting software like the Xero and QuickBooks that you can actually visualize and see some of these, as long as everything's up to date. So just start with a trading account. And what do we mean by a trading account? Is basically the sales and variable costs. So it's basically your sales and taking off the costs of sales against it, and just sort of it's the gross profit percentage, or whether your margins are improving or deteriorating. So basically, if you buy products and then and the revenue from it, whether that is creating a profit. Obviously, you've got other costs after that as well, so to get your net profit, but this is your sort of the trading account. So literally small adjustments, potentially have huge impacts on that, but we'll demonstrate that shortly, basically. So this is our trading company, foods company, the trading account. So here, what we've got here is just like the operating revenue, opening stock, purchase stock, and then just these are direct costs sort of that are associated with us, which gives us here your gross profit basically of 24%. So it's just an example of say food manufacturing in this case, and the sales, just over 1 million. So there, as you can see, you've got, total cost of sales, just 318,000. That'll come up later as well, coming back to this when in another report. Total direct costs, 450,000, and then the gross surplus. So that's basically the profit effectively on that is 248, and that gives you your gross profit of 24,000. So let's say the company is over and take some sort of strategic thinking, maybe works with us or someone else, and then or work with yourself and then implement some strategies just to increase the customer retention rate, and just results in like a 10% increase. So what that happens is that and they're just reviewing the inventory as well, so that then your inventory processing reduces their cost by 5%. So you increase sales by 10, lower your inventory by 5%, and then you also renegotiate sort of contracts for delivery and provide sort of 5% saving on direct costs potentially. So that would give you all this, and then the impact on that there is that you would actually have this going through. So oops, wrong slide. So on this, then basically the sales would go up effectively by the 5%, 10% here. You've got this going down by the cost of sales going down 5% because you've done some re-looked at cost and everything for the stock, so you don't need as much in at the same time. And then here you've just renegotiated things, so you've lost 5. So what that means, if you've got now a gross margin of 35,000, so you've increased by 144. So what you've done is done some changes to your sales, your stock, by lowering the amount you hold effectively, and here to renegotiated with suppliers effectively. So by doing this, you theoretically could get yourself an extra 144. So that just shows you with the numbers here on this, you can actually look to increase what you're doing. So understanding your trading just allows you to just identifies areas that with small improvements, you can make a big impact. So even if you didn't do 10%, you did 5%, you could, get half extra as well. So you'd end up with 70,000 instead. So it's just to be aware of things like this in the trading account. So we're now just going to go into the profit and loss. So your profit and loss, also known as as your income statement, that shows all your earnings and costs sort of over the year basically, and just tracks your overall performance of the business. And in these cloud software, accounting software, you see that on a monthly basis, which is really useful just to see where you're going. and it just matches the income and expenses for the period, and it does adjustments made for timing differences. Potentially sales have been made, but the money hasn't been received yet, so there's timing differences there. It's just also important to remember profit's not the same as cash, which we'll go into in more detail after. And profit shown in the profit and loss sort of includes non-cash expenses, which is potentially depreciation. So that's more of an accounting journal that we do at the end of the year, but we'll talk about that in one of the other reports. So you just need to ensure that you have sufficient profit to cover your cash costs, such as loan principal repayments, asset purchase, and drawings that you need to take yourself, because obviously you need to have a certain standard of living. So your profit and loss just provides just the framework and benchmark sort of your results for using percentages and comparisons between the years to compare just how your business is performing, and also against other similar businesses, which is normally quite useful. So business are sort of normally generally sort of valued on a multiple of your earnings on the P&L, basically, which is profit and loss. So it's a big driver of the value. It's not always the case, because it always depends on the business and what difference that you're looking at. So here's our example. So this is the profit and loss for a food company again. So we're just taking the gross profit trading from the trading account. So this is your gross profit we just saw earlier from the trading account. So that's the 248. So without all the adjustments. And then what we're going to do is just sort of try and make a bit more sense of this. So if you can see, like, the company is currently trading at a loss of 133,000. So that just shows you the gross was fine, but then you have all these other costs in here. You can sort of ignore depreciation in a way, because that doesn't, you have to have it there, but it isn't like the big impact that we need on it. But then you've got, let's say the company undertakes the review that we've said, expenses, sort of undertakes all their expenses, and the accountants, we just identify some savings, and then the insurance and rent, and the contact an insurance broker. We just contact them and the landlord and negotiate a 5% reduction. Say that sort of happens here. So you can see the 5% there, and then you've saved on insurance 597, and on these other ones here, the 2,800. I mean, the fees have gone up, so just so that's gone up already. So say for the accountancy, if we were doing it or someone else was doing it, the consultant, they would actually go up. But despite the increase, you've still got a surplus increase of 138 by 138 to 24,000 due to the saving that you had, basically, from the increases that we did and the adjustments in the earlier version on the trading account. So it's just to show that you may need to pay out some money to get some changes in, but by doing that, it actually works out better. But you need to plan all this. It's not something you can just do, because you need to make sure there is a reasoning for what you're doing. So then we're just moving on to the balance sheet. So your balance sheet is also known as the statement of financial position. Now that just provides a snapshot of your business, financial position at this specific point in time, and it sort of measures the net worth of the business, which is the assets less liability, and it shows if it's solvent. I mean, it's not always like that, but that's the main reason. So if your liabilities are greater than your assets, it means that it's insolvent, and you potentially need to do urgent action. The only thing it might not be is you may lend it a lot of money, so the net assets are actually okay, because you are not going to withdraw that money. And you can just compare different periods to determine whether the business net worth is increasing or decreasing over the years, which is always good to see. And then the stronger your balance sheet is, the easier it is for your business to survive in a downturn, which is what's happened with COVID. It also gives you a better credit rating as well, because that's the sort of thing that we report at Companies House, because it's your filleted accounts or your micro accounts. So that's where you get it, basically. And it's also the basis, like we've said here, of calculating key ratios. So it's a really, useful tracking the strength business. Here again, we've got the balance sheet of food company. So on this, it's currently insolvent according to this. So you've got net assets of 305,000. So in this example, it is insolvent. So something needs to be done. It's the working, so its working capital is also negative. So you've got this is the total current assets there. You've got your total current liabilities, and then there's your net assets. It's which is less. So then what we're going to be looking at, but assuming the company is resolving this urgent, but so just looking at issues. So over the long term, the company could implement strategies just to reduce its debtor days. So here you can see the debtors is 72,000, so that's quite high. So by doing that, what you'd be doing is look at your debtor days over the sales, and you get 365. So that's, and then you sort of get these 26 days. So if you're going to improve basically your debtor days, i.e. people are going to pay you 5 days earlier by just changing the contract. So basically asking them to do payments within 7 days instead of 26 days, then you could get yourself, an extra 13,944 in the bank. Basically, what that means is this trade debtors will go down and your cash at bank would go up by 13,000. So you'd have a good hit there. The other one you can look at is inventory. So inventories is 64. So what you could think about is this on your balance sheet is that it's 64,953. So what is the days of inventory? So you do that over the cost of sales times 265, which is your number of days, and that's where you get to 74 days. So if you review this, and you can just say, well, let's look at improving it by 9 days. So we just don't hold, or you won't hold, the company won't hold the inventory for 9 days. Well, hold it for 9 days less, and that would actually save 7,860 pounds. So that would actually improve cash flow because you wouldn't need to buy it straight away. So just assuming that all this is sort of goes through, while the cash flow is gaining, nearly 22,000, it doesn't fix the solvency issue, but it just demonstrates how it can sort of be saved if someone sort of helps just move things in the right direction, just to make sure you're getting out of that wrong sort of area that you're in. So that's just on your balance sheet. These are just things that you can look at. This is obviously a food company, but if you look at your debtor days, it's always worth looking at how you can get paid quicker, because then you get more cash in earlier, and you're also holding more cash, which actually means your balance sheet looks better as well, and it means you're more solvent. So the next one that we're just going to look at is the statement of changes in equity, and it just shows what happens to profits. And what I mean by that is they could be paid, dividends can sort of be paid out retained earnings. So if you don't have any retained earnings, you can't pay out any dividends. It sort of also represents sort of a net worth value of the company. So a very simple way of looking at it. I know we've said the P&L is also in there, but this is a very simple one. And this is also something that is seen at Companies House. And it also shows whether the company is solvent, which is what I said. So it just shows it if it's net negative or not. So we've just got an example of that again. So this is the example. It's sort of a cumulative loss here. So again, we've got this 305,000 total equity, because they've sort of made a loss over the last sort of 3 years effectively, and it's just gone through here. So you've got a loss for the period, and there's no dividend drawings, as you can see, due to that. So the one thing that I just want to talk about, so that's the statement. So if you have got retained earnings here, then you can actually draw a dividend, which is great. What we're just going to talk about, the next one, is director's current account, or the director's loan account. So this is just basically where you sort of run a record of everything that the directors is sort of owed by the business, so money there has been invested. and also money that's been taken out by directors, so netting it out. And it's like monitoring a personal expenditure for the business, from the business to you as a director, or from you. And it just shows how much businesses sort of owes each director. So you should have that if it's overdrawn, or if it means that director has taken out more money than they've put in, and then needs to then sort of put the money back in. And we do that via dividends normally. So we make sure that's paid off. If it is overdrawn at the end of the year, we do have a problem, and I'll just talk about that in a minute. But the idea is that we want this over. If it is overdrawn, we want it paying off. And we do that normally with dividends. And if it is in credit, that's great. That means there's money there to be taken out by directors tax-free. So here's just the director's current account. This is again just an example. So here we've got Mr. Joe. So Mr. Doe, J. Doe. So there, the opening balance there is 29,474 in 2020. So that's how much money they have owed to them. They've introduced £2,000, so that it will increase what they've got. However, they've actually taken out sort of some loan repayments of 8,000, and they've also had some personal expenses that went through the business that went against the director's loan. So Mr. J. Doe now has, at the end of 2020, 21,873 that he has owing to him. So he can take that out anytime, tax-free, which he did with the 8,000. But it just sort of ensures that there's a record of what the company owes. And if he owes anything, then that will be do the other way around. The issue, if the director owes the business money at the end of the year, when we do year-end accounts, is that it needs to be paid back 9 months, at least 9 months after the year end. Otherwise, there are tax implications on the director, and the bigger one is on the limited company. So what we try and do is always do dividends to pay off any, and that's where we would always be looking at all the way through. So we need to be very careful that you guys as directors don't overdraw your director's loan or take too much money out and you're not able to pay it back. What happens if you don't pay it back is that you would pay some extra, which isn't that much, to be honest, on your self-assessment on the amount. And then the business would actually pay 32.5% on whatever it is outstanding 9 months after the year end. This money does get paid back to the business and you as an individual, but only once the loan has been repaid. And it's a real pain communicating with HMRC this, and there's a massive timing difference. At the moment with HMRC, with furlough, with COVID and everything, they are backlogged massively. So it's always better not to be in this predicament, which is something that we always look with all our clients and partners, make sure that we don't have that issue once the dividend's paid. So we'll look at a different dividend policy to make sure that doesn't happen. So we're just moving on to the fixed asset register. I said depreciation reporting, and that's effectively the fixed asset register or depreciation schedule. So with that, you have your PCs, your plants, your machinery and equipment. That's all on there, and it's useful because it just keeps everything together. Means that you know what the business does own. And then if you do sell it, you'd actually take it off the register as well and have a sale of it through there. So you're actually keeping a register for it. It's just helpful also if you do sell the business, and also for replacement of your items. So I'm just going to show another example of that. So here, this is just the fixed asset register list and names of fixed assets. So you can see here, you've got your van, your car, software, computers, iPad, things like this. So what we do is here, this is your opening net book value. So what we say is your opening net book value for the year. So there's been depreciation, and that means this net book value at the opening of the year has gone down by the amount of the depreciation. So we also just add in the purchases here. to all this. This is the end of the year, just so at the start of the year, or sorry, the end of the year, just so we know what's been added and anything that's been disposed of. Because if it's been disposed of, we need to take it out. Then this is the rate of that they've been depreciated. So mainly 30% of the top van vehicle. That's per year. This is called reducing balance method. And then these are the variants. These are actually used to depreciate it. There's various methods that we use to depreciate items. And this is an accounting method. So what I'd say with all this is, so we've got the depreciation calculation. So that's basically this rate times by the total value of it after you've taken the purchase, and then you get the depreciation, and this is your closing balance. So at the end of the year, after you've taken out all this depreciation, your asset value is actually 268,000. So one thing just to note is that this is a paper exercise. There is something called the annual investment allowance, which currently is £1 million because they increased it because of COVID. It will go down in 2022 to 200,000. So when we do a corporation tax return, we take into account the depreciation, obviously, because it's in your profit and loss, but we take that out and we look at capital allowance and we look at that annual investment allowance, how much of that we can utilize at the moment. For most people, it's going to be all of it, and that goes off against your tax. So even though you purchase something and it's not on your P&L, the full amount, because you only have the depreciation amount, we would be able to allocate all of it against your corporation tax in that very same year, which is perfect because it means you don't have to worry about all the tax on it. You don't have a massive loss because of the purchase, but you still get the tax benefit of that purchase. What happens if you've made a loss that year is it gets brought forward to the next year. So we bring it forward, and we just need to make sure we as accountants keep a note of that so that when we do your corporation tax the following year, we utilize that allowance. So that's just on their fixed asset register. It's something we do at the end of the year, and it's a very useful thing that we do have. So we always have a list of all your assets. So those are, sorry, I should have said this. So these are sort of all the 6 main key reports that is sort of worth producing or reviewing regularly. The fixed asset register is something that is mainly an annual thing, but you've got your trading account, which you can look at regularly, especially if you've got cloud accounting, profit loss account, balance sheet, and the statement of change in equity. And it's definitely worth sort of keeping an eye on your director's loan account. And obviously you've got the fixed assets. So if anything coming in, we need that to do. But it just gives you a bit more view of how your business is doing. There are lots of ratios that we do on the back of this to sort of make sure everything's being recorded and sort of monitored properly as well. So what I'd say the next one is we've got just the difference between profit and cash. So the saying is turnover is vanity, profit is sanity, and cash flow is reality. So I don't really know who said that, but that's what everyone says. And profitables can just go out of business because it's starved of cash. So I mean, that's just worth knowing. So it's always worth looking at your cash, making sure that cash is there. The only issue that you have got, which we'll come on to, is by having the cash, it may not always be your cash, and you may suddenly have to pay things out. And that's why cash flow forecasting is actually really useful. But we'll come on to that in a minute. So this is basically just looking at the difference between profit and cash. So the VAT effect. So effectively VAT, you'd have more cash in your business, but it's not yours if you collect it, because you're basically collecting the VAT for the tax man at your 20% or whatever, if it's a lower rate. So that VAT money needs to be paid back. So what can happen is that you think it's your cash and it's not. So that could be an impact on the cash. So you need to pay that out. So what we do have is Some partners have a VAT account, so they put money aside in the VAT account, so a bank account, just to make sure that isn't getting taken out. Now, loan repayments. Now, the interest repayment, that does impact profit. So whatever you pay on interest, that would go off against your profit. But a loan repayment itself, that actually just goes off your balance sheet, and it impacts your cash. So if you have to pay back, say, your bounce back loan in full now, that would go straight off your loan repayment and your cash, and you would then also obviously lower your interest going forward on your P&L, but you'd have less cash. Then asset purchases. So this obviously affects your cash balance, but it doesn't impact your P&L, apart from on the depreciation side. So if you bought £100,000 worth of assets, you'd only depreciate, say, £2,000. I'm just but for that year, say, that would only go against P&L, whereas the 100,000 would come off your cash. We would also have the tax allowances against that as well. Asset sales, I mean, that obviously increases your cash. But as you can see, and the depreciation that only affects profits and is more of a sort of a journal that we do rather than a cash implication. And we have to do it, it's within the law that we have to do that as well for the Companies Act. So you can see sort of paying back a loan is a big thing. VAT, that does impact your cash, and it's also just paying corporation tax, things like that, that impacts your cash. So you just need to make sure you know when you need to pay them, how much that's going to be, and then make sure you've got enough cash for that. So it's always worth having sort of a savings account or a tax account that you can put things in. So this is just your business 101 cycle. So sort of a way of sort of showing the difference between profit and cash. So I'm just going to go through, I'll just have a quick glass of water. So with that, the first thing is like basically the owners. As an owner, you'd invest money into the business. So that's putting money into the business. Then you use those assets to basically generate income. So that's obviously the idea of always investing in your business. Eventually, it should be used to generate profit and an income. And you can increase this by potentially taking out new loans in finance, so you get more cash in, so you can do more. And obviously, that sort of does the increase in profits and returns. Your profits sort of get turned into the cash. Drains on your cash include sort of slow collection of debtors, high inventory days, loan repayments, tax repayments, payments to suppliers. And the business can sort of achieve cash gains by collecting their debtors faster, decreasing their inventory days, like we've mentioned, and negotiating longer payment terms with suppliers and reducing tags. So these are sort of the gains and drains of your profit, basically. And then owner, so this all generates the cash. So owners, then take out the cash for the business as drawings and personal loans, which we sort of talked about, and also dividends. And the remaining cash can then be reinvested into the business. So these are the drains. So cash drains, slow collections. And the gains is, faster collection, decreased. And then here, so the drawings here is you and the personal repayment. And the idea is, to accelerate the spin to increase the return on investment. So the quicker this is all done, so the input, output, process, output, the quicker that you sort of get the cash in. But you can see the difference in the profit to cash. So you can get the profit first, and then they come generate that into cash once it's paid. So it's just like the 101 cycle, which I hope is useful. So the key drivers of a business value. So there's after cash flow, business value is sort of the next most important measure for business success. So part of knowing your numbers is also understanding and measuring sort of the drivers of the business value. And these drivers, they might be like the monthly recurring revenue, the revenue growth, revenue per client, or sales per profit. And these will all be different. And every business is different. But you can work, you can work all these out and what is the ones that is right for your business. And these are sort of like, you create KPIs in the back of that as well. So the idea there is that you just need to look at your business, find out the key drivers within your business. Obviously we can help with that, but that's something that you can just look at, work those key value drivers out. You want to probably 7 max of these key drivers that you are focusing on as a KPI. We have covered that in another webinar, but it's just worth sort of knowing the key drivers. So enhancing the business value, and you must just first sort of develop and implement a clear plan. So it's always good to implement a plan and have it documented. And just, especially your organizational structure and the roles within the business. So what that means is people know what their roles are and you know what they are. It doesn't have to be massive, but it's just sort of looking at the organizational structure. One of our webinars will be talking about organizational structure and the 10 hats that you wear, especially as a business owner. And obviously as you grow, you give those hats to other people. But it's just knowing that structure and you being aware of it, as well as the people that work with you. And part of that here, I've sort of said, establish a cloud-based real-time reporting. And that's your Xero, your QuickBooks, which we use. So the idea there is you need to know what you are doing. With our partners, those that have never had a cloud-based and they move to it, they have just wished they'd done it ages ago, and they now see their business real time. They used to only know what was really happening at the end of the year, which is far too late. So the idea is there, you can, if you have cloud-based accounting, a lot of these reports are in there, especially the P&L and balance sheet. So you can actually follow that monthly, daily, however often. Just make sure your bookkeeping's up to date. So either you do that, we do that. And if you are doing bookkeeping, we can give you some tools just to help you do that a bit easier. So just reducing the reliance, on the owner, that's a key for any business to be successful long term. You as a business owner, or the business owner, doesn't want to be the key focus of that business. If they are, then they don't have a business really to sell, if they want to sell it in the end, or they aren't able to step out of the business and actually do other things in the future that they may want to focus on longer term. So it's useful to try and have a plan to make sure that you're going in the right direction, if that is your plan. And just identify and manage risk. So lack of cash is a big risk, but there could be risk in your business depending on your business, what those risks are. It's worth just being aware of them. With COVID, there's so many unknowns now, but every business has risks that can be identified. So as we've sort of seen through the webinar, profitability, cash flow, and value of your business all affect potentially you personally, just because the business is your lifeline. It's what you do. So if your business isn't profitable, it doesn't have much cash available, you won't sort of be able to pay yourself, fund the sort of desired lifestyle. So that's key behind all this, is making sure you are able to live the lifestyle that you want through your business, because that's where you come and you get your income from. But there's just a few things that can help protect the assets, which I'll just go through quickly. I mean, this is just sort of an add-on really. But by being a limited company, and so if you aren't, so and you move to a limited company, if you're sole trader, it just limits your sort of your personal liability, which is one, as long as you don't do anything illegal. It limits your liability, because then it becomes a criminal law. And then directorship, it's also worth considering who should be director of the company. and which assets are held personally by directors. So that's something just worth considering, just to protect the assets in the business. And then just the security of loans provided. So ensure that you have security over any money you lend to other people. So if you lend into another business or something, then it's worth sort of having security over that. And I'm sure banks always want some security, although with bounce back loans that we've been very blessed. So ownership options for high value assets. So the example there really is commercial premises. So if you have a limited company and you have your business running obviously through the limited company, and you also own a property in that limited company, within the limited company, it's worth looking at moving that property out of the limited company. The reason being that you're protecting that asset if anything happens to the business. Because if the business does go under, then you still have the asset of the property in a separate limited company, so that's actually safe. The other good thing there is you can actually sell either the business or the property easier if it's in a different structure, not within the whole limited company. So just terms of trade and credit policy. So it's always worth just reviewing that. If ensure that you only provide credit to customers who are likely to pay you. So it's always difficult if clients aren't going to pay you, or customers. So that's an issue that you need to sort of, and I'm sure you are, but just making sure the policies are correct. And insurance, you can just review insurances just to make sure you have sufficient protection. Business interruption insurance, indemnity insurance. I mean, we have to have the indemnity insurance, so we have to have that. Just enough to cover, impact to the business in adverse or minimal possibilities. One thing is interesting with insurances, there are ones that you can put through the business, so it's not a personal expense, it's a business expense. So it's always worth knowing what they are and what you are wanting. Financial planning. So it's always worth planning for the future. I mean, that's quite critical. So you can manage your personal wealth outside of the business. Now, it's worth doing an IFA, having a word with, we can't do this, by the way. So we have a partner, an IFA partner. So if you do want to let us know, we can put you in touch, Dan. But we can't do this, but it's worth having an idea of what that is. And then estate planning, again, that's not us, but it's planning for the future. So that with estate planning, that's powers of attorney. So just a clear plan of transferring assets either to the next generation, or if anything happens, God forbid, to yourself, if you're the business owner, what happens in that eventuality. So powers of attorney. So those are just 8. It isn't an exhaustive list. There are more, but these are just sort of a few ways you can sort of protect both your business and your personal assets. And it's just a way there just to try and help you. If you need any help on that financial plan, estate planning, let us know. We can put you in touch with people. And limited liabilities, obviously, we can help on that, no problem. But it's just worth having an idea there. So adopting best practice. So how does everything we've talked about, come together in best practice? So we did actually talk, that our last webinar was on the 3 essential tools. So this actually covers the 3 essential tools, which is an annual business plan. It is very critical, or so useful to have an annual business plan. It doesn't have to be much, just a page, 2 page, but just so you know what your plan is for the year. This can change, obviously, but it's worth having that. And then having an annual forecast. So that means that have a forecast of what you got, like a budget, effectively, of what's going to happen, what you think is going to happen, what you're aiming for. This can be high level, but it's just to know that. And then having ongoing reporting and accountability. So that's where you have potentially a board meeting, or you have management reporting, or you just reviewing things, and you give yourself KPIs, or someone else gives you, helps you create those KPIs, which we can obviously help with. But the idea there is you have ongoing. And then know your numbers. It's literally just the beginning. So, it is ongoing. Unfortunately, so it just allows you to improve your numbers and ultimately sort of achieve your goals. But by looking at your numbers, you've got the plans to move things forward, you've got changes that you want to be doing, and you can actually then see and quantify what's happening with the numbers. Without those numbers, you don't know, and the numbers don't lie. So they tell you the truth of what is happening, and if things are working how you wish them to. So that's basically the numbers there. So the next step. So these are challenging times, and the aim is to sort of help you with these webinars, just to give you ideas. Maybe you'll just write, it's worth sort of thinking if there's 3 things that you can do. We always say try and get 3 things, and then look at, see if you can implement anything. Even if you can't now, look at, it's just a way of thinking what you can do and have it planned for the future. So just take I mean, it's worth taking just a few minutes after the webinar just to write down some actions that you might want, and projects that will add value to the business. So if you have got a problem, that's great, because that's potentially a project that you can actually work on to make sure. So what problems, just think of what problems you experience in your business, you know, and then to identify those problems and then use them, just like I said, to an opportunity to create a project to fix them. And that should add value, but also hopefully mean that you have a better business to work in. And doing nothing is really not, you know, you need to be doing something in your business to sort of improve things in some way. And I'm sure it's very difficult if you're constantly going through trying to churn everything. So it's worth having that thinking time, as we call it, have a thinking time to see what you can do and create some projects, look at what you can do just to improve things. And even if it is just looking at your P&L on a daily basis, weekly basis, monthly basis, if you've got Xero, QuickBooks, you can do that. Just make sure your bookkeeping is up to date. So how can we help you? I mean, to be honest, these are the same sort of things that we mention most times with this COVID time. You know, there are lots of issues out there. The impact of COVID, we are hoping that everything's going to open up on the 21st of June. We'll be back in our office on the 21st of June, which will be nice. As long as things don't go backwards. So with this, you know, you've got the business plan, so which we just made, the cash flow forecast. So with the cash flow forecast, you need to also do a business, a profit and loss and balance sheet. So it's a 3-way forecast, but that's something. Board meetings, and then management reporting, regular ones, monthly, quarterly. This is how we can help you. So we can actually help you deliver these. We can work with you on these. Obviously, we do also have a complimentary meeting. So if you want to have that, let me know, and then we can sort of have a look through and see what they might be able to do just to help things go forward. And I mean, in all of this, there are benefits in doing things, and it's worth doing something yourself as well. You don't need to, you know, but it's just worth thinking of what you can do. And it's definitely an idea, just not to think that the cash is an issue, but without doing anything. So if you have a cash flow problem, you need to think about what you can do, which we've gone through. If you've got a P&L problem, as you're making a loss, it's worth thinking about it. Sometimes it's difficult, but as long as you've got the projects and the plans in place to move things forward, that's the main thing. So any questions, guys? I've talked a lot and I really do apologize, but if you've got any questions, please do put them in the Q&A, because it's just something that we have. I've got one here that I'm just gonna go with. If you've got more, just please do put them in. So what's the difference between an annual accounts and accounts that can be produced throughout the year? So the answer is basically that annual accounts, they just contain end of year adjustments and everything that are at the end of the year, and it's historical. They have things like depreciation in and tax, and splitting interest and principals. So there's all these sort of accountanese type things that we do in year-end accounts, because we have to make it so it's allowed to be, it's in the correct format for the government and Companies House, according to the Companies Act. So the main difference really is that it's historical, though, and then regular management accounting, it gives you regular data, so you can actually make decisions real time rather than looking back in the wheel, the wing mirror, and it's too late. Then you can make decisions, but it's not going to affect all those months that you didn't realize. And then also, it just all depends. So it's always worth looking at things on a more regular basis, on a timely basis. The key to it is making sure your bookkeeping is up to date, and ideally being in a cloud-based accounting system, because these days there's no excuse not to be in a cloud-based accounting system, because it is the best thing that you could ever do for your business. And okay, I've got another one. What's the difference between markup and margin? So we've spoken about the gross margin, basically. This is the question. You've spoken about gross margin. Is that the same as markup I put on my prices? The answer to that is yes and no, because markup in terms of sort of pounds is the same as the margin, in that both are difference between the cost price and the selling price. But in terms of a percentage, the markup on a margin are not quite the same. So I'm going to have to speak this, so I can't draw it, but basically, just if you give an example, so if you buy stock, it's £75 and you sell it for £100. So you sell it for 100 and you bought for a 75. Your markup is 33%. So that's £100 over 75, which is 33%. That's for your markup. So that's your markup, 33%. However, your margin is 25%, because it's £25 divided by 100. So that's 25%, because you sold it out for 100 and you made a profit of about 25. So so there is a difference between the profit, the percentage, the margin, and the markup, if that makes sense. So I hope that does make sense. So we normally look at the margin rather than the markup, because the markup isn't yes, it's a big markup, but bigger markup, but it's more the margin. So what happens? This is another question. What happens if you are not able to pay off director's loan? Now, if you don't pay off director's loan, first of all, we look at, as accountants, we will always look at your director's loan and want to pay it off 9 months after year end. Like I said, otherwise you have to pay 32.5% through the business as tax. So we look at dividends. So the first thing is we'll try and do as much dividend up to the year end. If we can't then pay it all off, we'll then look throughout the year after, for the 9 months, if we can pay it off then. So otherwise, you will need to pay in the extra bit. So if you can pay it in, perfect, then you pay it in and pay it off. However, if you still can't do that, then we have to contact HMRC, and the company would have to pay 32.5%. It's actually a written form separately, and then you as an individual would have to have it on your self-assessment and pay some extra tax. You would get it back, as I mentioned, but it's a timing difference, and it's a real pain to do from companies, HMRC. And at the moment, like I said, they are running really late with everything. So I've got one more question. I'm just going to have a drink. So if you've got any more Q&A, just let me know. But I've got another one here. Can you go into a business plan in more? No, so we can't go into the business plan in more detail here. I actually did it in the last webinar, the 3 essential tools. And if people do want that, we can always repeat it. So in the future, that's not a problem. But yeah, unfortunately, I haven't got a video of it because there was technical difficulties on that. So we haven't got that videoed. But yeah, so hopefully that's if you do want it, just let us know. We can do that again. But okay. So I don't know if there's any more questions, but how long we've been? We've been half an hour. So I whizzed through that one. So I hope that has been useful to you all. Oh, I've got one more cue. Let me just see. Cool. Yeah. So we will. Yeah, Chloe. We can definitely look at the repeat. The webinar itself, I should have a recording as long as things have gone as I meant it. So what will happen is we'll have a recording, Claire. So we're going to say we'll send you that. So you can have that recording of it. What we will be doing normally, unfortunately, I didn't do the last one. There was an issue there, but we have got the one before that recorded. It's on our YouTube channel, the Naylor Accountancy YouTube channel, so you can follow that or subscribe, which would be great. We haven't got many people on there, but what we're doing is building up more material for that, and we're going to be doing more of these, like I say. And if you have got any thoughts, guys, on anything else, let me know. You can just send me an email, or even other ones, because we are doing more. Like I say, the next ones is no, I can't even remember the next one is. So let me just have I'm going to just have a quick look. All right. So the next one is going to be. So I'm just going to go back quickly through the slides, if you don't mind. I've got to go right back. So the next one is. So I'm going backwards. I'm sorry. Probably not the best way of doing it. I'm getting better at these. Unfortunately, these are all new to me. But so this is my third one. But so the next one is going to be getting paid. So it's more sort of on cash flow and everything. That's on the 18th of June. And then it's building your business well in July, and then reclaiming your time, and then the 10 hats. The 10 hats I'm looking forward to, because I actually really like that, and the core values. I think they're really important. But anyway, yes, Claire, we'll send them. That'll be excellent. Any other questions? Oh, cool. Thanks. So, no, well, thank you, everybody. Thank you for joining, and thank you for spending your time on a Friday. And hopefully we will see you again. So yeah, I mean, do have a look at the YouTube channel on the Building Your Better Business if you want that one. We will look at doing the 3 essential tools for business again. I'll just have to work out when, because I've got quite a tight schedule here, and then I'll let you all know. So I hope they have been useful. If there's any things that you think we can do better, please do let me know, because I am learning as we go through these. All right. Well, happy Friday, everybody, and take care. Thank you. Bye. Bye.